Your next area is common probability distribution, starting with the end of chapter questions from your curriculum. Question number 1. A European put option on stock conveys the right to sell the stock at a pre-specified price, called the exercise price, at the maturity date of the option. We don't have to know the details of derivatives. It's just for the sake of statistics, just you need to do this question. So no deep knowledge of derivatives is needed. The value of this put at maturity, the put option is basically the right to sell. And the value of this put option at maturity can be calculated using this formula: exercise price, also called the strike price, minus the stock price, or 0, whichever is greater. Just that you need to know. Suppose the exercise price is $100 and the underlying stock trades in ticks of $0.01. At any time before maturity, the terminal value of this put is random variable. Now the question is, even we don't have any knowledge of derivatives, describe the distinct possible outcomes for terminal put value. Think of, this is just the hint given by the examiner, by the writer. Think of put maximum and minimum values and its minimum price increments. We need to describe what kind of, what would be the overall array of data. It could be as low as 0, as high as 100, value put option, right? So, and the in between array of data would be in increments of 0.01. So basically what we are talking about, that it would range somewhere from 0 to $100, and the sequence would proceed this way. So on here till 99.9 and then $100. So it could be from minimum of 0 to a maximum of 100, and it can assume any of these numbers as I've listed, with a progression of 0.01 in each subsequent term, right? So it will be from 0.0 to this. So these are the possible outcomes of terminal put. That's what you need to know. How do we calculate the gain on put and call option? That's totally beyond the scope of this topic we're doing right now. Next, is terminal put value from 0 to 100 at a time before maturity a discrete or a continuous random variable? Since it can assume just a combination of these, just out of these numbers up to 100. So they are a set of discrete numbers. There is no other possibility other than this. A continuous random variable can assume any number. For continuous random variable, anything can, we cannot specify the nearest value. Like here we can specify from 0.01, the next number will be 0.02 and then 0.03. We know with specific increments these would be the sequence of numbers. But in continuous random variable, it could be anything. 0.01, the next number could be 0.0134 or 0.01939, for example. Any number. So since we have only these numbers possible from minimum to maximum, so that means it's a discrete variable, not a continuous one. So it's a discrete random variable. Next, the same question, but the requirement is a little different now. Okay, letting y stand for terminal put value, express in standard notation the probability that the terminal put value is less than or equal to 24. We just have to give it in a statistical standard notation, nothing scientific. So the probability of terminal put value being less than 24 or equal to 24 could simply be put this way: probability of y is either less or equal to 24. That's all. Or if you wish to give in the cumulative distribution function format, it would be F24. That's all. Next. Well, define the term binomial random variable and describe the types of problems for which the binomial distribution is used. First, binomial random variable, like for example, if we toss a coin, either the head would appear or the tail. Only two possible outcomes. Only two possible outcomes. So number of success, like for example, if tossing a head is success and tossing a tail is failure. So binomial random variable basically is defined as the number of successes in n Bernoulli trials, head or tail, or maybe I perform a certain experiment, 70% probability of success and the failure 30%, which is normally labeled as Q. P is 70%, Q is 30%. So successes in n Bernoulli trials, this is what you call the binomial random variable. It can take only two outcomes, success or failure, and then constructing a probability using these outcomes is what you call the binomial distribution. It's a straightforward textbook question and you are not required to define in your level 1. It's all MCQ based. You just need to select the right option. So let's jump on to the next question. Yes. The value of the cumulative distribution function fx, where x is a particular outcome for a discrete uniform distribution, sums to 1. The value of cumulative distribution function doesn't sums to 1. If you add these all up, the number would be clearly greater than 1. So this option is incorrect. Then the value of cumulative distribution function lies between 0 and 1. Yes, that's true. Between 0 and 1. So this is the minimum value you could have, this is the max. So it lies between 0 and 1, and it decreases as x increases. This is wrong as well. As x is increasing, as you can see from 1 to 2, 2 to 3, 3 to 4, we have fx increasing 15 to 45, 80, and then 100%. So this is wrong as well. So that makes B to be our correct option. Next, if for a binomial random variable with 5 trials, n is 5, and a probability of success on each trial is 50%, P is 0.5, and normally I would prefer using Q rather than using 1 minus P, means the same, is 0.5. See, the probability of success, the probability of failure, they are both the same. So such a binomial distribution where the probabilities of success and failure are the same, such a binomial distribution is called symmetric. And if it's not so, then it would be asymmetric. So clearly it is symmetric. That makes C to be the correct option. Like this one. Moving on. In a discrete uniform distribution with 20 potential outcomes of integers 1 to 20, the probability that x is greater than or equal to 3 but less than 6, and he has given you the notation, probability of x being greater than or equal to 3 and less than 6 is. Now first of all, we need to first determine the probability of each outcome starting with 1. 1 out of 20, that is 1 by 20, meaning 0.05. Right? Since it's a uniform distribution, so probability of 2 is 1 by 20, 3, 1 over 20, 4, 1 over 20. Or each will have the same probability because it's a uniform distribution. What we are required to do is to calculate the probability of x being greater than or equal to 3 and less than 6, which means you need the probability of 3 plus probability of 4, probability of getting a 5 and not 6. Less than 6 means 6 is not included. So we have the probability of each of these events being 0.05. So there are 3 such possibilities times 3. So it should give you 0.05 times 3, 0.15 or 15%. So here is your option B is the right one. B. Next. Over the last 10 years, a company annual earning increased year over year 7 times and decreased year over year 3 times. Out of the 10 years, incomes increased 7 times, decreased 3 times in a period of 10 years. You decide to model the number of earnings increases for the next decade as a binomial random variable. Okay, the question, what is your estimate of the probability of success defined as an increase in annual earnings? What is the probability of success being increase in annual earning? Clearly, out of 10 years, 7 years witnessed increase in earnings, so it's basically 7 out of 10. That is 0.7. And then if this is P, then what's going to be Q, or called 1 minus P? It's 0.3. So that's what we're looking for, 0.7 or 70% based on the record of the past 10 years. Next question. What is the probability that earnings will increase in exactly 5 of the next 10 years? Exactly 5 out of the next 10 years. Now, we have the numbers. N is 10. P, the probability of success, that is 0.7. Then Q, remember Q, I have been using this for the last 20 years. So we may call it 1 minus P or just Q, makes the same, 0.3. So what is the probability of earning that the earning will increase in exactly 5 of the next 10 years? So that means you're looking for X is equal to 5, right? NCR, that is 10C 5. P power R, that is 0.7 raised to the power 5, into Q, that is 1 minus P, 0.3 raised to the power 10 minus 5, that is 5 as well. Now if you simplify 10C5 by using your calculator, 10 combination 5, it will be 252. 0.7 raised to the power 5 is going to be 0.16807, and this one, 0.3 raised to the power 5, would give you 0.000243. So if you multiply and simplify them all, you will get around 10.2919%, or simply 10.29%. That's all. Then next, calculate the expected number of years earning increase during the next year. EX, we have read the basics of this reading. It's basically NP. What is N? 10. 10 years. The probability of success, that is 0.7. So 10 times 0.7 gives you 7 only. Right? C is done. Then, now calculate the variance and the standard deviation of the number of yearly earnings increases during the next 10 years. All right. Variance is equal to NPQ. That is what I have been doing, and you may write it 1 minus P. I'm repeatedly saying don't confuse yourself. It's either Q or 1 minus P, makes no difference. N is 10 years. Probability of success is 70%, that is 0.7, and failure 0.3. So if you simplify these all, 10 times 0.7, 7 times 3, 2.1. Now this is the variance, and if you need standard deviation, simply take the square root, and square root of 2.1 would be square root of 1.449. Right, that's all. Simple, straightforward as it is. Next little twist expected. The expression for the probability function of a binomial random variable depends on 2 major assumptions. In this context of this problem, what must you assume about annual earnings increases to apply the binomial distribution in part B? What reservations might you have about the validity of these assumptions? Yes, there are two assumptions in binomial distribution, binomial random variable distributions. First, the probability of P and Q are constant in all trials. First. And second, the probability of success is independent of any previous trial. Like I throw a coin, it would either be head or tail, and it doesn't depend what was the outcome in the previous trial. Similarly, the probability of success or failure in any particular year doesn't depend upon the prior year returns. So these two conditions are important. Now, here the question says, the expression for the probability function of binomial distribution variable depends on two major assumptions that are discussed. In the context of this problem, what must you assume about annual earnings increases to apply the binomial distribution in part B? And what reservation this part B? What is the probability that earnings will increase in exactly 5 of the next 10 years? Since we have just agreed that the probability of any subsequent trial is independent of the prior result of the previous trial, hence taking your current year as a base and predicting the returns for the future period, well, that's the violation of the assumption. Past earnings should not help us forecast next year earning using binomial distribution model. Condition 1 is violated. And further, if there is some economic downturn or the business cycle, right, it affects all the firms and it will affect the earnings. And again, something has happened outside our scope of studies that is affecting the probabilities of success and failure. So in this case, neither the assumption is likely to hold if there is economic upturn or downturn, or if there is any industry cycle involved. So that's the reservation. That's why this model in this case will have limited application. Next, a portfolio manager annually outperforms her benchmark 60% of the time. Assuming independent annual trials, what is the probability that she will outperform her benchmark 4 or more times over the next 5 years? Now here we have n is equal to 5 years. Okay. The probability of success is 60% or 0.6. Probability of failure is then 0.4, of course, 40%. And what we are looking for, the probability of success in 4 or more times over the year. That means there are going to be two possibilities. Probability of x is equal to 4 plus 5 as well. Because it said 4 or more times. So it could only be 4 and 5 because there are just 5 periods involved. Right? You just need to plug in the numbers. NCR, that's going to be 5C4 P raised to the power 4 and Q raised to the power 5 minus 4, that's 1. In this case, it's going to be 5C5 0.6 raised to the power 5 and 0.4 raised to the power 5 minus 5, that's 0. Right? You can just simplify this and let me do this for you. 5C4 times 0.6 raised to the power 4 into 0.4 gives you 0.2592. And this one, 5C5 is 1. It's basically 0.6 raised to the power 5. It is going to be 0.07776. And if you add these two, you'll get 0.33696, which I believe is approximately B. And that makes B to be your correct option. You are examining the record of an investment newsletter writer who claims a 70% success rate in making investment recommendations that are profitable over 1 year time horizon. Okay, this is what he claims his success rate to be. over the last 10 years. You have the 1-year record of the newsletter's 7 most recent recommendations, and 4 of those recommendations were profitable. If all the recommendations are independent and the newsletter writer skill is as claimed, what is the probability of observing 4 or fewer profitable recommendations out of 7 in total? So instead of going for our observed value, let us test his claim. He claims his P to be 70%, and of course Q would be then 30%. Right. Out of those total 7 years, and basically we are taking as 7, we need to see what is the probability of observing 4 or fewer profitable recommendations. That means you are going to add up all the probabilities from P0 all the way to P1, P2, 3, and 4. 4 or fewer means could be 0, none out of those 7, or it could be as high as up to 4, so 0 to 4. So what you will do, 7C0, 0.7 raised to the power 0, and 0.3 raised to the power 7 minus 0, that is 7. And you will go all the way till here, that is 7C4, 0.7 raised to the power 4, and 0.3 raised to the power 7 minus 4, that is 3. So if you calculate all these results, instead of just wasting our time on the computations, the total of this would somewhere be around 35.3. It's fairly straightforward computation. Just have to, it's little time consuming, but it's straightforward. Just need to apply the formula on all these 5 probabilities and add them up. It'll be 35.3, and as you can see, you've just seen the result of 35.3. From P0 to P4 all added, and you got your result. Next, what is the expected value of sales for the 4th quarter? Now this is a different question, not the question number 8. This is a different question. You are forecasting sales for a company in the 4th quarter of its fiscal year. Your low end estimate of sale is 14 million euros, and your high end estimate is 15 million euros, alpha and beta, if you remember from our reading. You decide to treat all outcomes for sales between these two values as equally likely using a continuous uniform distribution. Now, what is the expected value of sales for the 4th quarter? I hope you remember from your previous learning. If you have these two high and low values, if you need to calculate the expected value, you simply take the average, alpha plus beta by 2. So if we expect 14 million euros to be the lowest number and 15 million to be the highest sales figure, you simply just add these two and divide by 2. So that will be 14.5 million euros right here. Then next, what is the probability that 4th quarter sales will be less than or equal to 14.125? Less than or equal to 14.125. Remember, this is the lowest sale expected. This is the highest sale expected. We just want to calculate what is the probability of getting sales number 14.125. So I hope you remember from your prior learning, since it's a continuous uniform distribution, so everything falls between beta and alpha, and since we have been given the minimum value we need, at least 14.125, then we're going to take 14.125 million minus 14 million upon 15 million minus 14 million. Straight application of formula we discussed in the reading. So if you simplify this, this is what you are trying to estimate the probability of sales be between 14.125 and 14. So simply apply the formula and the result would be 12.5%. Simply 14.125 less 14 upon 15 minus 14, and that's the probability of sale being between this range. Alright, next. State the approximate probability that a normal random variable will fall within the following intervals. Mean, normal distribution, mean plus or minus 1 standard deviation. So one standard deviation, the data, or what you say, the 68%, approximately 68% of all the outcomes in the random variable will fall between one standard deviation from the mean. This is your mean. Mean plus or minus 2 standard deviations. This will incorporate 95% of all the outcomes, and 3 standard deviations will incorporate 99%. So I'm sure it's just a revision of what we have done. 68, 95 and 99. Next, find the area under the normal curve up to z.36. So z.36 would be somewhere here, right? So what you will do, simply open your z table, look up 0.30 in the column 0.06. So this is what it is, 64.06. Now this is the number. What is the interpretation? The interpretation of 64.06% for z.36 is that 64.06% of observations on a normal standard normal random variable are smaller than or equal to value 0.36. It means the area under this region is 64.06%. The observations, out of the total observations, 64.06% are in this region. That's what it means. Next, if the probability that a portfolio outperforms its benchmark in any quarter is 0.75, that is P. The probability that the portfolio outperforms its benchmark in 3 or fewer quarters, that is 3, 2, 1 or 0. 3, 2, 1 or 0, because we need the portfolio outperform its benchmark in 3 or fewer quarters over the course of 1 year. Now, we have P as 0.75, and then of course Q, or 1 minus P, is simply 0.25. Right? And here is 4, because there are 4 quarters in 1 year. So 3 or 4 quarters, 3 or fewer quarters, it means out of 4 quarters we need 3, 2, 1 or 0. So it's going to be sum of 4 probabilities. In none of the quarters our portfolio outperformed. Only once in 4 quarters, 2 quarters out of 4 quarters, or 3, not 4, because it said 3 or fewer. So what you will do here, 4C 0, 0.75 raised to the power 0, Q, which is 0.25 raised to the power 4 minus 0, that is 4. And you will do the same for this, and the last one will be 4C3, 0.75 raised to the power 4 minus raised to the power 3, and Q, that is 0.25, is going to be 4 minus 3, 1. So you will calculate this one, this one, this one, this one. If you add all these numbers, your result should be equal to 0.684 as is given in the solution, and that would make C to be the correct option. Fairly straightforward question. You need to know how to apply the right formula in the right place, and there you go. Now look at this, is something a bigger question, quite a just a bigger one. There is not much computations required. Let's read this first. In futures markets, profits or losses on contracts are settled at the end of each trading day. This is called mark to market. This procedure is called marking to market or daily resettlement. Gain or loss is settled on daily basis. That's how future markets work. By preventing a trader's losses from accumulating over many days, marking to market reduces the risk that the traders will default on their obligations. If you have an open position in a future contract, the losses and gains are settled on daily basis, so that not to allow you to carry on your loss-making position for a longer period. This could, because the future market is highly leveraged, so it can't be allowed for a trader to carry on the losses in the future. It is settled on daily basis. A futures market trader needs a liquidity pool to meet the daily market to mark to market. If liquidity is exhausted, the trader may be forced to unwind his position at an unfavorable time, incurring further losses. Suppose you are using financial futures contracts to hedge a risk in your portfolio. You have a liquidity pool, cash and cash equivalents of lambda. This is frequently used in physics. Lambda, dollars per contract, and a time horizon of T trading days. Lambda represents the dollars per contract. T is the trading days, time horizon of trading, T days. For a given size liquidity pool, Lambda, Kolb, Gay and Hunter 1985 developed an expression for the probability stating that you will exhaust your liquidity pool within T days horizon as a result of the daily mark-to-market losses. Kolb et al. Assumed that the expected change in futures price is 0 and that the futures price changes are normally distributed, with standard deviation representing the standard deviation of daily, this sign, this sigma representing the standard deviation of daily future prices changes. The standard deviation of price changes over a time horizon to day T is given by standard deviation into square root of T. He has given you the formula, it's all the detail of how it works. Given continuous compounding, with that background, the Kolb et al. Expression is given by this formula. Probability of exhausting liquidity pool that you will use to settle your open positions in mark-to-market accounting is equal to 2 into 1 minus nx, where this is the normal distribution score, where x is equal to lambda upon standard deviation times square root of T. We will solve this. Here x is the standardized value of lambda. Nx is the standard normal cumulative distribution function. For some intuition about 1 minus nx in the expression, note that the liquidity pool is exhausted if losses exceed the size of liquidity pool. If losses are more than the pool, you're gone at any time up to and including T. The probability of that event happening can be shown to be proportional to an area in the right tail of the standard normal distribution. That's all theory. What we are required to do, using this and this, you are required to solve something. Using the Kolb et al. Expression, answer the following questions. Your hedging horizon is 5 days. T is 5 here. Let me, T here is 5. All right. And your liquidity pool is 2000. Okay. Then what? Per contract. That's basically lambda. Dollars per contract. 2000 per contract. Your estimate that the standard deviation of daily price changes for the contract is 450. What is the probability that you will exhaust your liquidity pool in 5 days period? T is 5. This 2000 is the dollar per contract. 450 the standard deviation. We just need to plug in the numbers in this and calculate the probability. Just computations. Let us just write down the numbers in a clean sheet and do the workings. What have we been given? We may need something else to write because the system is not allowing us to write here. So using the numbers from the given information, our standard deviation is 450, time horizon is 5, and lambda is $2,000. Right, these are the 3 inputs we need. First thing we need to find is x. And as per the formula, x is equal to lambda upon standard deviations time t. If you plug in the numbers, it's 2000 upon 450 and square root of the 5. If you simplify this, it will give you 1.987616. This is x. Now, this is the first step. This is the first step. Now what you will do, you need to round it off to 2 places of decimal, 1.99, right? Now go to the table and see in the table value, what is the value in the table. Let us open the table if it's possible. Now if you look this number up in the Z table, what you will find, and 1.99 is going to be 0.9767. Now coming back to the formula that will give you the probability of default, the formula is 2 into 1 minus nx, which we have calculated as 0.9767. So if you simplify this, your result will be 0.0466, which means with $2,000 as lambda, 5 days time horizon, 450 standard deviation, there is 4.66% probability that the liquidity of the pool would be exhausted, or 4.7 approximately. So you just simply need to plug in the numbers for x, lambda, standard deviation, t, whatever the number comes, need to look it up in the Z table, and then simply whatever the result comes, plug it in this formula. All is given. It's 2, 1 minus nx, and this is the formula to calculate x, and that's as simple as that. Alright, same question. Suppose your hedging horizon is now, instead of 5, it's now 20 days. Hedging horizon is 20 days, but all the other facts given in part A remain the same. What is the probability that you will exhaust your liquidity pool in 20 days period? You will do the same thing what we've just done. You will do exactly the same thing. Let me just take you directly to the solution. You will plug in, instead of 5, here you have 20. 2000 is lambda upon 450 in square root of 20, it's 0.9938, which is 0.99. So what you will do, you will look up 0.99 in the Z table, and you will find the probability to be 0.838. Now what is the probability of exhausting your liquidity pool? This is the formula. This 2 into 1 minus nx. 2 into 1 minus n.99, which you found the value to be 0.8389. Simple as that. Just application formula. Our result comes out to be 32.22. Now look at this. This is now higher probability. If your time horizon is 20 days, so there is 32.2% probability, quite a substantial probability, that you will run out of your funds to meet the mark to market. So longer is the duration, the period, more probability is that you will run out of your liquid funds. You will run out of liquidity in mark to market accounting. It's nothing difficult. It's just that you need to apply the formula correctly and just use the Z score and then solve the questions. Alright, next. Which of the following is characteristic of normal distribution? We have read this quite a lot of times. Normal distribution. This is the normal distribution. It is not asymmetric, rather it is symmetrical. This is incorrect. It has definitive limits on the boundaries. No, the data is, there is still some data at the tail, so we can't say that's when the boundary ends. It doesn't have a definitive limits or boundaries. What we are sure that it has kurtosis of 3. That's from our prior learning, so that makes B to be our correct option. Next. Which of the following assets most likely require the use of multivariate distribution for modeling returns? Multivariate distributions normally are used for group of related random variables. Let's say if I have two stocks, stock X, stock Y, and these are the returns of stock X, returns of stock Y, and they are correlated with the coefficient of correlation R, right? And this stock X has a mean and a standard deviation. This stock Y would have a mean and a standard deviation. So this way, bivariate model in this case, you need two stocks or two or more, two bonds, two or more. So basically, multivariate distribution is used for modeling returns of portfolio of technology stocks more than two or two. Not a single call option or stock in a particular market index, right? So multivariate distributions specify the probabilities for group of related random variables. So portfolio of technology stocks represents a group of related assets. It's a group that we're looking for, two or more. right? So that makes B to be the correct option. Now, the total number of parameters that fully characterize the multivariate normal distribution for return on two stocks, that is the example I drew it for. The parameters here, the coefficient of correlation, the means of both, and the standard deviations. So that gives you a total of 5. 2 means, 2 standard deviations, and 1 coefficient of correlation. So a bivariate normal distribution will have 2 means, 2 variances, and 1 correlation between them. Right? Alright, moving on to question number 17. A client has a portfolio of common stocks and a fixed income instrument with a current value of 1.35 million. She intends to liquidate 50,000 from the portfolio at the end of the year to purchase a partnership share in a business. Furthermore, the client would like to be able to withdraw the 50,000 pounds without reducing the initial capital of 1.35 million. The following table shows 4 alternative assets allocation. She can put in A, B, C, or D with these expected returns and these standard deviations. Given the client's desire not to invade 1.35 principal, she doesn't want to use up this capital. What is the shortfall level RL, the minimum return? Use this shortfall level to answer part B. That's the later part. So we need to find out the threshold return. She needs at least $50,000 out of the investment she has made of 1.350. If you calculate 50 is what percentage of 1,350? It's going to be 3.7%. This is the minimum return she needs. Otherwise, she will have to attack her principal. So 3.7% is what she will need to earn to not to invade her capital. Right? Otherwise, if it's this is the minimum return. And I think that's what we need here. That's the next part where we need to go for. So shortfall level to answer part B. Okay. That's what 3.7. So any return less than 3.7 means that the principal will be invaded. The return above than this is good. So this is the minimum threshold return on the portfolio or on the stock. Okay, now this is the next question, next part. According to safety first criterion, which of the allocation is the best one? Apply the safety first formula for all. And it says that here, it said that use the shortfall level to answer part B. This 3.7 will be used as the minimum threshold return. Let us calculate the safety first ratio for A. I hope you remember what I'm doing. It's from our reading. 16, that is the expected return, minus the threshold 3.7 upon the standard deviation 24. If you simplify, the result would be 0.5125. You do the same with B. 12 minus 3.7 divided by 17. One simplified will give you 0.488. For C, 10 minus 3.7, 10 is the expected return, 3.7 is the threshold, and upon standard deviation, it will give me 0.525. 0.525. And lastly, for D, it's 9 minus 3.7 divided by standard deviation, and it gives me 0.48. And I hope you remember from your reading that higher the result, safety first, higher the better. Select the one with the highest. It's 0.512, 0.488. I think the A is giving you the highest one. A has the highest 0.512, but C is also C is 5.525. This is the highest. C is offering you the highest value 0.525. 0.525. Allocation C with the largest ratio 0.525 is the best alternative according to the safety first criterion. Right? Okay, next. I think it's the same data. Yes. What is the probability that the return on the safety first optimal portfolio will be less than the shortfall level? Now here we need some z-score computations. We are looking for the possibility of return being less than 3.7. The probability of return being less than 3.7. For this we need to convert this 3.7 into the standard score. How do we do that? 3.7, we calculated for 3.7, the z-score was calculated as for B, which we thought to be the best, 0.525. 0.525. Since it's in the negative region of the normal distribution here, negative 0.525. All right. Now what you will do, you will open the z table, right? And from there you find the value of 0.52 under 5. And then since it's in the negative region, so you will deduct this from 1 minus whatever the value you get. It has given here that you will get 0.7019. 0.7019. So 1 minus 0.7019, it will give you approximately 29.81% or 30%. There are two ways. Either you do it 1 minus the value you find in the z-score, or there is also a separate table given for negative values. If you use that table directly, you will get this percentage directly. So whichever option you want to use, fine. So as per this number, there is roughly 30% chance of not meeting the minimum return threshold of 3.7, right? And that's given right here. Next, question like these are good where the table is already given, so we can just see the numbers right there and then. Here, a portfolio has an expected mean return of 8%, okay, and a standard deviation of 14. The probability that the return will fall between 8 and 11. So we are looking for a probability of return between 8 and 11. We have to convert them into corresponding z-scores. How do we do that? It's 8 and what was given? 8, and first let's calculate for 11. 11 minus 8 upon standard deviation 14. 11 minus 8 upon 14, and if you simplify it gives us 0.214 or simply 0.21. So we're looking for, and when you calculate for 8, it's going to be 8 minus 8. Interestingly, mean happens to be 8 as well. 8 minus 8 upon 14 is 0. So basically you're talking about something like this, z 0.21. So what you're talking about is you need to calculate the probability between these two z-scores, and here we have the normal distribution. This is your 0, and somewhere here you have 0.21. So basically you're talking about this region from 0 to 0.21. From 0 to 0.21. So what you will do here, you will calculate, or I think it's right here, we can see here from 0.2, 0.2, 1. It's, see, 0.2, 1, 0.5832. 0.58. So this whole region till here is 0.5832. But we need only this shaded part. So the region from here to here is 0.5832, but we just need this part only. So it means what we are looking for is 0.5832. The whole area under the normal distribution from here till here, we need to remove this white part so as to get only this part that is needed between 0 and 0.21. So it's going to be 0.5832 minus 0.50, because this region here, let me highlight this one. This is basically 0.5. This region here is 0.5. And what I calculated was here. From here to here, that is 0.5832. From this, we need to deduct this yellow part, that's 0.5. So it will then give you just 0.0832, which is basically 8.3%, which is given as A. Right? And A is your right answer. Now, a portfolio has an expected return of 7% with a standard deviation of 13%. For an investor with a minimum annual return of 4%, the probability that the portfolio return will fall to meet the target is closest to. Now we will convert into standard scores. Let us standardize these numbers first. For we are looking for probability of X being less than 4. So we need to first convert this into z-score. It's going to be 4 minus mean upon standard deviation, that is 13. So 4 minus 7 upon 13. It's a negative number, negative 0.2307. So what you're talking about is that the region is somewhere here. So either you just look this up in the negative z table, since it is not given here, because z here has all the positive numbers. So what you are going to do, you're going to take this value as 0.23, which is 0.2 and 0.590, right? So it means the region up to this point is 0.590. So since we need only this part, so you're going to deduct 1 minus this value from here, 0.5910. And once you do 1 minus 0.591, it's going to be 0.409, or simply 41%, which is given as B. So if you don't want to use this long process, you can simply use the negative, the Z table for negative values, and you just look at that 0.23, you will get this number directly over there. It's your choice, totally. Done, so it's B. Next. Well, I'm not going to go for the definitions. This is something that is something that's in your domain for reading. Let's just define Monte Carlo simulation. Well, Monte Carlo simulation involves use of computers to represent the operation of a complex financial system. That's what it is. And explain its use in finance. We use Monte Carlo simulation to represent the operation of a complex system, or to find approximate solution to a problem. That's your domain. Reading would do in this region. Fine, sits there, given there. Compared with the analytical methods, what are the strengths and weaknesses of Monte Carlo simulation for use in valuing securities? Compared with analytical methods, what are the strengths and weaknesses of Monte Carlo simulation? It's a straight textbook based question. If you have read the theory well, you'll be able to answer this question. And of course, it's not something you would be tested on your level 1. It's define and compare it. Options are there. You need to select the right option. The strength is Monte Carlo simulation can be used to price complex securities for which there is no analytical method possible or available. Right? This is one strength. And what is the weakness? Monte Carlo simulation provides you only a statistical estimate, not a very accurate or exact result. Right? Analytical methods provide you more insight into cause and effect. Monte Carlo simulation does not provide you the cause and effect, so relationships. That's an important difference. Right? Next. A standard look-back call option on stock has a value at maturity equal to value of the stock at maturity minus minimum value of stock during the life of the option prior to maturity, or 0, whichever is greater. This is, of course, we'll discuss in our derivatives. If the minimum value reached prior to maturity was 20.11 and the value of the stock at maturity was 23, means 23 minus 20.11, that's as per the formula, the value of the stock, which is 23, and the minimum value of stock during the life option, that was 20.11. So the difference is 2.89 given. Briefly discuss how you might use Monte Carlo simulation in valuing a look-back call option. In Monte Carlo simulation, we generate probability distributions. This is what can be varied. Varying the minimum value of stock during the life of the option and calculating the terminal value of option and then discounting it at a certain rate will give you the result for 1. Do this again. Calculate terminal value with a different minimum value of stock. Whatever the result comes, discount it back to your 0. Do this repeatedly. Once you do it, then many results will be obtained, and simply take the average. Average of these values at T0 over all the simulated trials will give you the simulated value of look-back call option. Right? It's a textbook extract, shouldn't be in the MCQs, but curriculum has included this question for the sake of understanding. Moving on, which of the following is a continuous random variable? Continuous random variable means it can assume any number. A value of future contracts quoted in increments of 0.05, it will always be in the multiple, not the multiples, will be in these ranges. Next number is predictable. So it is not continuous, it's discrete. The number of heads recorded in 1 million tosses of a coin. Again, it's a discrete number, not a continuous one. Cannot assume any value. So this is discrete as well. The rate of return on a diversified portfolio of stocks over the 3 months period. The rate of return could be anything. In points, could be 3.79432 or 11.43119 or any number could be. So this is an example of continuous random variable. Next. X is discrete random variable with the possible outcomes of 1, 2, 3, 4. 3 functions fx, gx and hx are proposed to describe the probabilities of the outcomes in X. Okay. The condition for probability functions are satisfied by which of these functions? There are two conditions that must be satisfied by any probability function. First, the probabilities are between 0 and 1 and the sum of probabilities is equal to 1 and can't be negative. You can simply reject this. This is not possible. Probabilities cannot be negative, right? And let's now add up these. They fall between 0 to 1, so they do look to be genuine, legitimate probability functions. If you add these all up, 0.2, 0.45, 0.95 is exactly 1.0, which is 100%. If you add these 0.2, 0.45, 0.75, wow, it's 1.1, impossible. Probability cannot be more than 1. So it appears Gx fulfills the conditions. It's between 0 and 1 and sum of probabilities is equal to 100%. So Gxb is the right answer. Next, again, a distribution function is given. What is required? The cumulative distribution function for a discrete random variable is shown in the table below. The probability that X will take on value of either 2 or 4. If you're given a question like this, I always recommend you to just split these. Since it's a cumulative distribution, you can break this down. From going probability of 1 to 2, the difference is 10. So basically, X has 10% probability. From going 25 to 50, the gap is 0.25, which means it's 25%. First one is clearly 15%. 4, 50 to 60, it's 10%. Then 35%, and then finally 5%. Now these are the single probabilities of each of these events, each of these values. So since we needed the probability for 2 or 4, so that would mean 10 and 10. 20. Fine. A is the answer. Correct. Which of the following events can be represented as a Bernoulli trial? Those that can be portrayed into 2 outcomes, success or failure, like flipping a coin. So clearly that rules out all BCs. That makes A to be the correct option. A trial such as coin flip will produce one of the 2 outcomes, such as trial in the Bernoulli trial. That gives you A to be the correct option. Alright, next question. The weekly closing prices of Modis Corporation shares are as follows. On 1st of August, on 8th of August and on 15th of August. the continuous compounded return of modest corporation shares for the period from August 1st to August 15 is closest to, I'm sure you know the formula, natural log of S1 S0, and that's simply ln 120 upon 112. Is a fairly straightforward thing to do, and if I do it on my calculator, ln bracket 120 upon 112 close, it gives me 0.06899, which clearly tells me 6.899% or 6.9, perfectly A. Straightforward, no twist in whatsoever. Next question. A stock is priced at 100 and follows a one-period binomial process with an up move that equals 1.05 and a down move that equals 0.97. If 1 million Bernoulli trials are conducted and the average terminal stock price is 102, the probability of an up move is closest to. Let's say the probability of up move, we don't need to say let, it's already given us. Up move is P. And then what is the probability of down move? Just like in Bernoulli, we know if it's P, if it's 70, 1 minus P or Q is 30%. Right? So if the probability of move is P, the probability of down move would be 1 minus P or Q. I'm going to put it as 1 minus P because I have to find P. So putting a Q will put you in trouble. So rather than just writing Q, write 1 minus P because 1 minus P is basically Q. Right? Now, if this is so, we are getting an average terminal stock price of 102. It says the up move is 1.05. Of 100 it's going to make 105. And down move equals 0.97. 0.97 of 100 met, that means $97. So P times 105 up move plus Q times 97, that is down move, it gives you an average of 102. We just need to make P the subject of this equation. 105P plus 97 minus 97P is equal to 102. 105 minus 97 gives you 8P, and 97 when taken to the other side gives you 5, which means P is equal to 5 by 8, and 5 by 8 means 0.625, which is 62.5. So that's the P. Fairly straightforward question. Now this one, good one, a little time consuming as well. A call option on a stock index is valued using a 3-step binomial tree with an up move that equals 1.05 and a down move that equals 0.95. The current level of the index is 190 and the option exercise price is $200. Call option, the right to buy, $200. Now, if the option value is positive when the stock price exceeds the exercise price at expiration and $0 otherwise, the number of terminal nodes with the positive payoff. Now let us just construct the binomial table. 190 up move will raise 190 by 5%. 190 times 1.05, remember this is what I'm talking about. 199.5. And a down move will mean 0.95 times, it's going to be 180.5. Now the second, again 199.5 up move 1.05 gives you 209.475, and a down move 199.5 times 0.95, it gives you 189.525. Here 180.5 up move now will give you 189. 5 to 5, don't need to do it, and down move 180.5 times 0.95 gives you 171.475. Further up move down 209.475 times 1.05 gives you 219.9488, And 189.525 up move will give you 189.525 times 1.05. It's 199.00125. And here the down move 189.525 times 0.95 gives you 180.04875, and in this case 171.475 times 0.95 gives me 162.90125. What's the question is now? We have done it. What we need is, if the option value is positive when the stock price exceeds the exercise price at expiration and zero otherwise, the number of terminal nodes in three-step binomial tree with a positive payoff. Now you have a call option that gives you the right to purchase the stock at $200. Now listen to me very carefully. You have a call option that gives you the right to purchase a stock at $200. When this will pay you positively? If the market price is 162, you will simply throw the option away and go and buy in the market. When the market price is 180, exercise price is 200 for the call option, you will simply go to the market and buy at 180. When you have a hold a call option at $200 exercise price, the market price is 199, you go to the market and throw the option away. It's only in this situation where your call option at exercise price of $200 is valuable, has a positive payoff, because you get a share by paying $200, a share that is currently trading at 219.94. This is the only node where there is a positive payoff. So the number of terminal nodes with a positive payoff is only one, 219.9488, and that makes A to be the correct option. Look at these, all are less than 200, only this one is where your call option is in the money. It gets you benefit. Next, a random number between 0 and 1 is generated according to a continuous uniform distribution. Now, what is the probability that the first number generated will have a value of exactly 0.3? Now, since it's a continuous uniform distribution, so in this case, the probability of generating a random number equal to any fixed number is 0. That's a simple book-based question. A Monte Carlo simulation can be used to do what? Directly provide precise valuation of call option. Estimate, statistical estimate. Simulate process from historical records. Wrong. This is historical simulation, not Monte Carlo simulation. Then what? It tests the sensitivity of the model to changes in assumption. Correct. It assesses the sensitivity of assumptions could be changed, and then it will change the overall outcome of the trial. C. Limitation of Monte Carlo simulation is its failure to do what if. Wrong. It actually helps you do what if. Change the inputs and the outcome could be changed in trial. So this is wrong. It's a totally wrong statement. It's not a limitation, rather it's an assistance. It requires historical records of the return. This is wrong. It is for historical simulation. Then this is the limitation. Limitation of Monte Carlo simulation is inability to independently specify cause and effect relationship. Cause and effect relationship is established using analytical methods, not the Monte Carlo simulation. So that's why C is the right answer. Which of the parameters equals 0 in a normal distribution? In a normal distribution, skewness is 0. It has kurtosis of 3, but skewness is 0. And it does have a standard deviation from the mean at certain points. So this is clearly skewness as our answer. Skewness is 0, not standard deviation. B is the right answer. Normal distribution has a skewness of 0 because it is symmetrical around the mean. A non-zero skewness implies asymmetry in the distribution. We know that from prior learning. Alright, next question number 33. An analyst develops the following capital market projections. Stocks, mean return 10, standard deviation 15, bonds mean return 2, standard deviation 5. What are we looking for? Assuming the returns of the asset classes are described by normal distributions, which of the following statements is correct? Bonds have higher probability of negative returns than stocks. So we know in the normal distribution this region is negative, assuming this is mean 0, and this region is positive, right? Now let us convert these into the corresponding z-scores, assuming the returns are 0. 0 minus 2 upon 5 gives you negative 0.4, and 0 minus 10 upon 15 gives you negative 0.67. Now, it means 0.4 standard deviation from the mean. That would be somewhere here. And in this case, negative 0.67 standard deviation from the mean. It means now you can see here this region is bigger than this one. So bonds have a higher probability of negative returns than the stock. So you need to see it from point of view of times of standard deviation, 0.4 times standard deviation and 0.6 times standard deviation from the mean, right? So that makes bond to be a riskier investment in this case. Next, a client holding 2 million portfolio wants to withdraw 90,000 in 1 year without invading the principal. According to Roy's safety first criteria, which of the following portfolio allocation is optimal? All right, first let us do this for A. Let us calculate the safety first ratio. We know it's going to be, first we need to find out the threshold. 90,000 is what percent of 2 million? If you do that, 90 by 45, 4.5 million, 4.5%. Okay, let's do it for it one by one. 6.5, that's the expected return on allocation A, minus threshold return upon the standard deviation. If you simplify this, it will give you 0.24. For this, 7.5 less 4.5, the threshold upon standard deviation, gives you 0.294. And for C, it is 8.5 minus 4.5 upon 14.34% gives you 0.279. Now, the higher the better. That gives you B to be the correct option, allocation B. In contrast to normal distribution, log normal distribution are skewed to the left. Wrong, they are skewed to the right because they don't have negative values. Have outcomes that cannot be negative. Correct. Outcomes that are not negative, that's the correct option. Are more suitable for describing asset returns than asset prices. Wrong. Asset returns can be negative, but prices are either 0 or positive. So yes, that's right. Returns can be negative, but prices are normally either 0 or positive. So that's true. C is the right option. I think I did it other way around. Have outcomes that cannot be negative. Correct. Are more suitable for describing asset returns than asset prices. No, rather they are suitable for asset prices, not returns. That's what we have concluded. So B is the right option. B is the right one. The log normal distribution is more accurate model for the distribution of stock prices than the normal distribution because stock prices are non-negative. They are non-negative. Prices are not either 0 or they have some number, so they are non-negative. So that makes C to be the correct option. The price of stock at T0 is 208.25. At T1 is this. The continuously compounded rate of return from T0 to T1 can be calculated using ln S1 on S0 is equal to ln 20, basically it's going to be 186.75 value price has fallen upon 28.25. Simply plug it in your calculator and you should get your straightforward result. Since the price has fallen, so it will give you 0.1090, which is approximately 10.9% negative. That makes A to be the correct option.